Colin Fisher joins me now, Portfolio Manager and President of StableView Asset Management. Colin, welcome back.
Thank you for having me.
Colin, recently I've been observing a phenomenon whereby companies in the United States don't go public until they're worth at least $1 billion. They don't necessarily deliver a positive experience in post-IPO because of that. But in the case of, I'm going to use Peloton as an example, the stock came out at a $6.5 billion valuation and is now trading at a $5 billion valuation. Not collapsing by any stretch of the means, but not delivering the instant wealth that people have come to expect from some unicorns. So my question is, do we have any companies in Canada that are potentially capable of delivering that kind of multi-billion dollar value appreciation once it goes public?
Yeah, I mean, so Peloton is a consumer-facing company, which we typically don't have. So you'll have Facebook, you have the Googles. Canada is a B2B company, so the country. All of our businesses are primarily focused on B2B.
Right.
Primarily because we're a small market economy, we're only 35 million people, but the problems that you solve at the business level are typically pan-global, and they're going to be able to be used by a much larger audience. So if you have an accounts receivable issue in Canada, the accounts receivable issue will be the same in the States as it is in the UK, as it is in Europe, and so on and so forth. When you deal with consumer products, that's a much bigger problem. We're just not a very big market. We have very few products. You've seen this year 3 companies that got funded. You saw Vena Solutions earlier in the year got a $150 million raise. We were shareholders in that. We actually sold into that raise. Clio out in Vancouver recently raised, I think it was about $250 million. And I don't know what the valuations are, so I wouldn't be surprised if they're raising $250 million that they're already at a unicorn stat. By the way, a Canadian unicorn is a narwhal.
Okay.
And those are real. Right. Our unicorns are real. So a narwhal, so I believe, but there's actually some truth to what I'm saying. There's much more real revenues behind these companies. They're much more investable. And then the last one of late was Verafin out in Newfoundland. And so we have them already. We just typically don't see them surfaced for a whole host of reasons, primarily because a lot of U.S. money is coming into those, and they'll stay private longer, or they'll just get bought out writ large. We have many companies. Kinaxis was a $1 billion plus, is a $1 billion company. Descartes is a $1 billion plus company.
These are not exactly household names, though.
But again, Descartes is business to business. It's supply chain and logistics for transportation, for whatnot, but it's a very solid business. Constellation Software, a bit of a different bug in that they're buying up different companies primarily. So it's a bit of a thing of things.
Right.
And then you have Altus Group. So Gary Yeoman founded Altus Group. That's now a $1.5 billion company. We don't, and by the way, I don't own shares in anything that I just mentioned so far. But Altus is an excellent company. They own software called Argus. They do a bunch of tax consulting. Gary Yeoman founded that company. Gary Yeoman was also a founding investor in Real Matters, and Real Matters is I think it's a few bucks away from $1 billion. So we have a lot of companies that go public that then are $1 billion companies. I think part of the problem is that they're not very sexy, right? Peloton is sexy. It's forward. It's consumer facing. It's an interesting company, and so because it's not, the same reason that a company is interesting because it's consumer facing, right, is the same reason why a lot of these B2B companies are less interesting, because they're company to company. So a lot of people, it won't ignite the imagination. Gary Yeoman recently we're part of a company, invested in a company called iLookabout, so we're big shareholders. There was just they bought some assets from a company called Clarosity. We had to unfortunately put the company into foreclosure.
iLookabout is up on the screen right now. Is that a holding of yours?
That is our we're a big holder in that.
Okay.
The spike of recent was they presented at our technology conference. We do this every year. We had a little over 500 people this year in attendance, and they presented on the big stage. So it ignited quite a bit of people's imagination. So here we have Gary Yeoman, who founded $1 billion company, Altus. He was a founding investor and board of director member at Real Matters. Just recently, James Kelsey joined the board of directors. James Kelsey was the former vice chairman of commercial banking of Bank of Montreal. So he just recently retired. He's one of his first boards that he's joined is now iLookabout. I mean, there's a reason guys of that caliber are joining the board of directors. And then most recently, they just got $3 million of term loan and line of credit. So they have very good cost of capital, very low cost of capital. We have a CEO that has built $1 billion, has been part of $2 billion companies that have grown. So narwhals or unicorns are prevalent in our system. The vast majority are private in nature, so the access is very difficult. I've mentioned to you before, we're launching, we soft launched the concept for Garrison Creek, which is going to help invest in a lot of these companies on the balance sheet side in an equity friendly way in the growth phase of a lot of these companies. But you look at these companies out there, there's a lot of companies that come out. Acuity Ads has gone from a very small base, I don't know, I think they're in the $100-200 million range right now. They could easily get into the $1 billion range, I think, in the next 3 to 5 years.
Sure.
I think iLookabout, they're now, I think they're, if you spitball, it's around 30 million if you look forward, if you make a guesstimate. And so their current enterprise value to revenue is very, very low. I think it's close to like 0.85 or something like that.
Okay.
With someone like a Gary Yeoman at the helm, who's had proven to be able to do it not once but twice, I think you can look at this growing materially from where it is now.
Right.
So we do have them. I think there's far more than we give credit. Part of it is we just don't do the fanfare around it. Like every time a company that breaches $1 billion, you'd think someone would make some sort of noise about it, but we don't. We do it like the States builds a WeWork that is now literally imploded.
Yeah, well, that's one of the fundamental differences between Canada and the U.S., for example, is that you can raise a lot of money on cotton candy in the United States before the belief falls out of the system, and you've got to explain yourself. I mean, case in point.
Yeah, I think one of the big fundamental differences is that Canada, because of the capital constraints writ large for technology, is that you have to maintain some sort of orbit of profitability, like towards break even. You can't just be burning money Mach 10 and just going for land grabs.
Unless you're a cannabis company. But that's over too now.
Well, I mean, listen, I was never part of that. I never understood it. And again, that's consumer facing typically, right? Which is not our typical strength. But, there's a lot of money that will go into these concepts and then eventually the wheels fall off. But that happens a lot more in the States because if you get a winner, it's just such a big winner. It's just a massive winner. Whereas in Canada, we have far more winners of the 250 million, 300 million, 400 million, but those are the redheaded stepchildren that are unloved by the venture world, and therefore they don't typically get funded. And what happens is a lot of these grow up in, Texas is another one. I think they're in the hundreds of millions of dollars, supply chain and logistics for hospitals. They also do the LCBO. We still own shares in that company, I believe. Very good company, really interesting company. So when you look at a lot of these companies, there's this pattern of boring, this pattern of solving a very specific problem. There's a pattern of understanding the growth curve much more normally for us. The US wants a more vertical growth pattern, and therefore they will fund it, and there's both good and bad to that. There's a lot of, for every Facebook, there's hundreds of thousands, if not millions, of dead twitching bodies on the side of the road that were like MySpace, for example, right?
Napster.
Napster was more of the sharing platform, but not wholly dissimilar. So those will get funded, and they'll figure out how to monetize. They'll figure out what the actual market is for it. Whereas, the Gary Yeomans of the world that build an Altus that's doing taxation for property, where iLookabout, when you think about it, they're back in, they do a lot of the systems for MPAC, Municipal Property Assessment Corporation, which is every house in Ontario gets a tax bill from MPAC. It's actually the largest tax authority in North America. It's the second largest in the world. But that doesn't ignite the imagination. Most people you tell,
No.
do you get a tax bill? And they're like, yes, I get a tax bill.
Well, yeah, exactly. I looked at the company, and it was, you know, I understood what it was doing in the real estate space, but it didn't excite me because I'm looking at it and I'm thinking, well, is this going to capture market share from traders who are looking for the hot thing to invest in? Is it going to capture market share from investors who are looking to participate in a longer term development curve? Which is
one of the reasons we built this, like the deal we put together, going back to the Garrison Creek concept, what we wanted to do is leave a calling card of what a deal would look like if a Garrison Creek went in and invested. And now StableView is the investor in here. The deal post-acquisition was 0.65 EV to revenue, where all of their comp, if you take a slice of different comps, they were trading at 4.5. So what we've said is we're putting the deal together and we're leaving money out on the table for you to go and pick up.
right.
So these types of deal, we want to make it so that we are perceived as being shareholder friendly and equity friendly when we go on the balance sheet, or if we take both positions. We are both equity holders and debt holders in this particular.
This was financed at 0.5x of revenue to EV.
Yes.
Wow.
0.65 when the deal closed. Yeah.
Okay. Well, that's I see. That's what you mean. But again, I mean, you look at the trading, and it's like the market doesn't really appreciate it.
Well, it started to appreciate it post the deal, post the tech conference. You'll see that the volume has started to pick up. But listen, this is a smaller company, and it's not Apple or Google. So once these pieces of news happen, it doesn't nothing. It's not like there's a million eyeballs on this thing. The deal closed between Clarosity and iLookabout, I think July 18th. I was in a hospital bed in Austria when that damn thing closed.
Sure.
So that's one of the issues, is that there's just not a lot of eyeballs on these things. There's a huge, the cannabis is interesting because from the day they legalized it, all stocks are down. Like it was the peak, was the anticipation of, like, maybe not all of them, but the vast majority, the industry writ large. I think the ETFs are all down from the day of legalization. And so part of it is because now they're like, well, what's the next catalyst? What's the next catalyst? So that's catalyst driven with massive valuations. This is the opposite. There's tons of catalysts that are already baked in, and the value, I believe, will start to be realized over time, which is why we're big investors in the company.
Great. All right, we'll leave it there for now, Colin, and have you back soon. Thanks for joining me again today.
Thanks for having me.